Comfort is rarely questioned. It feels earned. A stable income, a predictable routine, bills paid on time, weekends intact. There is nothing dramatic about it. And that is precisely the problem. Comfort does not feel like a ceiling. It feels like arrival. You worked for stability. You secured reliability. You reduced volatility. That seems intelligent. But stability without expansion becomes containment. When your needs are met, urgency declines. When urgency declines, ambition softens. When ambition softens, risk tolerance narrows. And risk tolerance determines growth. Not effort, not intelligence, tolerance. Comfort reduces the perceived need to change structure. If the paycheck arrives, if the lifestyle functions, if the pressure is manageable, why disrupt it? That question is rational in the short term, but destructive over long timelines. Because the system does not pause when you become comfortable. Costs rise, assets appreciate, capital compounds. If your structure remains static while the environment compounds, you are not maintaining position. You are slowly losing ground. The cost of being comfortable is invisible early. You don't feel decline. You feel peace, predictability, reduced stress. But predictability also narrows perspective. You optimize inside the role you occupy. You refine skills that increase your value within the system. You rarely build leverage outside of it. Comfort incentivizes incremental improvement. It does not incentivize structural change. Incremental improvement increases income. Structural change increases independence. Those are not the same. If your life functions well enough, you rarely question dependency. Dependency on employer, dependency on market stability, dependency on continued performance. As long as nothing breaks, the ceiling remains invisible. But ceilings are not felt. They are realized later, when someone else's asset base has doubled, when opportunity appears and you cannot move, when volatility arrives and you must protect stability instead of pursue growth. Comfort trains you to protect what you have. Protection feels prudent, but protection without expansion becomes stagnation. Stagnation is not collapse. It is slower separation. While others reinvest aggressively, you refine routine. While capital compounds, you maintain equilibrium. Maintenance feels responsible, but maintenance does not scale. Scaling requires discomfort. Discomfort forces re-evaluation. Re-evaluation creates leverage. The people who escape financial ceilings rarely do it from comfort. They do it from tension, from recognizing that stability alone is not strategy, from understanding that predictability can become a trap. The trap is subtle. You become good at surviving, good at budgeting, good at optimizing. But survival optimization is not wealth creation. Wealth creation demands exposure to uncertainty. Ownership requires risk tolerance. Compounding requires margin. Comfort compresses all three. If your life feels fully stable, fully optimized, fully predictable, ask a harder question. Is this stability expanding or containing you? Because comfort is not failure, it is limitation. And limitation compounds quietly when left unexamined. Comfort does something subtle. It recalibrates your standards downward while making you believe they are rising. When your life becomes stable, your goals begin to shrink to fit that stability. You stop asking what is possible. You start asking what is reasonable. Reasonable is safe. Reasonable fits inside your current income. Reasonable protects your current routine. Reasonable does not disturb equilibrium. Equilibrium feels intelligent. But equilibrium inside a growing economy is passive decline. If your structure does not expand, relative positioning shifts. Others accumulate assets. Others reinvest returns. Others compound. You maintain. Maintenance is invisible stagnation. It feels responsible. It feels disciplined. But it rarely builds leverage. Leverage requires friction. Friction requires discomfort. Discomfort threatens comfort. So most people avoid it. Comfort trains you to preserve what exists. Preservation is not expansion. Preservation is defensive. Wealth creation is offensive. When you are comfortable, you negotiate for small improvements. Slightly higher salary, slightly better title, slightly better lifestyle. All linear upgrades, none structural. Structural change looks disruptive, reducing expenses when you could upgrade, redirecting surplus when you could celebrate, taking calculated risks when stability feels good. The system prefers you comfortable. Comfortable workers do not challenge structure. Comfortable earners do not aggressively accumulate. Comfortable consumers sustain demand. Comfort creates predictability. Predictability benefits institutions. Unpredictability benefits owners. This is not conspiracy. It is alignment. If you are comfortable inside the system, you are likely reinforcing it more than redesigning your position within it. Redesign requires tension. Tension forces reallocation. Reallocation builds assets. Assets build independence. Independence reduces ceiling. Most people never redesign. They refine. They improve performance. They optimize habits. They increase efficiency. Efficiency inside the wrong structure deepens the trap. You become better at sustaining comfort, better at protecting routine, better at avoiding volatility. And volatility is where leverage is created. Volatility carries opportunity, but opportunity requires readiness. Readiness requires margin. Margin requires restraint. Restraint is uncomfortable when life feels good. So expansion of lifestyle continues. Bigger baseline, higher fixed costs, more commitments. Each added obligation tightens the ceiling. Each fixed expense narrows flexibility. Each lifestyle expansion increases required income. Required income reduces optionality. Optionality is freedom's foundation. The cost of being comfortable is reduced ambition for structural change, reduced ambition for ownership, reduced urgency to compound. Over long timelines, that reduction compounds more than you realize, not into collapse, into limitation. A financial life that is stable but capped, secure but constrained. Comfort does not destroy progress. It slows it just enough that you mistake motion for growth. And that miscalculation is expensive over decades. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. The longer you remain comfortable, the more expensive change becomes. Early in your career, compression is easy. You can lower expenses, relocate, take calculated risks, reallocate income aggressively. There is flexibility. But comfort hardens over time. You upgrade housing, you upgrade transportation, you increase recurring commitments. Each upgrade feels incremental, none feel structural. Structure changes quietly. Your baseline rises. Your required income rises. Your tolerance for uncertainty falls. When baseline rises, freedom shrinks, not dramatically, gradually. Gradual shrinkage is rarely noticed. This is where the compounding layer appears, not compounding of wealth, compounding of dependency. Higher fixed expenses require higher stability. Higher stability reduces risk tolerance. Lower risk tolerance reduces ownership. Reduced ownership limits compounding. Over time, the path narrows. You cannot reduce income without stress. You cannot pivot without compression. You cannot take advantage of volatility. Volatility becomes threat, not opportunity. Meanwhile, those who accepted earlier discomfort benefit from expanding leverage. They built margin before expansion. They accumulated assets before upgrading lifestyle. Their baseline remains controlled. Their optionality expands. Optionality compounds. When you can say no, you negotiate better. When you can wait, you invest strategically. When you are not pressured, you think clearly. Clarity produces better allocation. Better allocation produces stronger assets. Stronger assets reduce required effort. Reduced required effort increases control. Control is what comfort promised, but rarely delivered. Comfort delivers predictability. Control delivers autonomy. Autonomy requires the ability to absorb instability. Absorbing instability requires margin. Margin is expensive when your baseline is high, because reducing baseline later feels like regression. This is why many high earners feel trapped. Income is strong, lifestyle is strong, obligations are stronger. The ceiling is invisible but firm. Breaking that ceiling later demands sacrifice that feels disproportionate. Selling assets, downsizing lifestyle, rebuilding runway. All of it feels like moving backward even when it is strategic. The earlier the discomfort, the cheaper it is. The longer the comfort, the more rigid the structure becomes. Rigid structures resist change, and resistance increases cost. Financial cost, emotional cost, identity cost. This is the real price of comfort, not lost income, lost flexibility, lost leverage, lost time for compounding. Time compounds everything. If you compound ownership, it builds wealth. If you compound dependency, it builds ceilings. The system will not interrupt your comfort. It will reward it. It will promote it. It will stabilize it. Because stable participants are predictable. But predictable positioning rarely produces exceptional freedom. It produces steady containment. And containment over decades becomes indistinguishable from limitation. Comfort is not failure. It is a plateau. And plateaus feel safe until you realize how long you've been standing still. At some point, the question changes. It is no longer, am I comfortable? It becomes, what is this comfort costing me? Not emotionally, structurally. What opportunities have you declined because stability felt too important? What risks have you avoided because volatility felt unnecessary? What ownership have you delayed because your income felt sufficient? Sufficiency is dangerous, not because it is wrong, because it removes urgency. And urgency is often the catalyst for structural change. Without urgency, you refine. You do not redesign. You optimize salary. You do not expand ownership. You improve lifestyle. You do not increase leverage. Leverage is what removes ceilings, not income. Income supports the present. Leverage reshapes the future. When you are comfortable, you trade upside for predictability. Predictability reduces stress, but it also reduces growth velocity. Growth velocity determines separation over decades. Small differences in allocation become massive differences in autonomy. The person who reinvests early benefits from exponential acceleration. The person who consumes early benefits from temporary satisfaction. Temporary satisfaction compounds into higher baseline. Higher baseline compounds into dependency. Dependency compounds into constraint. Constraint limits decisions. Limited decisions limit strategy. Limited strategy limits wealth creation. This is why comfort is expensive. It charges you in missed compounding. It charges you in delayed ownership. It charges you in reduced optionality. And the bill arrives later. Not in year 1, not in year 3, in year 15, when peers with similar starting points have built asset bases that move independently of them. At that stage, catching up requires compression. Compression feels painful because it demands lowering lifestyle that has already normalized. Normalization is powerful. You adapt quickly to upgrades. You rarely adapt quickly to reductions. So instead of compressing, most people maintain. They protect equilibrium. They continue optimizing inside the same ceiling. And ceilings do not feel restrictive until ambition expands beyond them. By then, the structure is rigid. The cost of change is high. The psychological resistance is higher. There is another layer. Comfort shapes identity. You begin to identify with stability, with predictability, with being responsible. Risk begins to feel irresponsible. Ownership begins to feel uncertain. Uncertainty feels threatening. But uncertainty is where leverage is born. Ownership is built in imperfect conditions. Compounding rewards those willing to endure short-term instability. The people who escape ceilings rarely do it from deep comfort. They do it from intentional discomfort, from disciplined compression, from redirecting surplus into assets instead of upgrades. Comfort is not the enemy. Unexamined comfort is, because unexamined comfort becomes permanent structure. Permanent structure becomes permanent ceiling. The cost of being comfortable is not collapse. It is limitation. And limitation compounds quietly until it feels like destiny. But ceilings are not destiny. They are constructed. And what is constructed can be restructured. Comfort is not something to eliminate. It is something to question. There is nothing wrong with stability, nothing wrong with predictable income, nothing wrong with enjoying what you've built. The danger is unconscious expansion. If every raise becomes a lifestyle upgrade, you are not increasing freedom, you are increasing baseline. If every stable year becomes a reason to add obligations, you are not building leverage, you are building dependency. Dependency does not feel heavy at first. It feels normal. You adapt to new expenses. You normalize higher standards. You integrate commitments into identity. Identity makes ceilings invisible. If you identify with your current structure, you will protect it, even if it limits you. Protection feels responsible, but protection without expansion creates stagnation. Expansion without structure creates fragility. The balance is deliberate. The solution is not extreme deprivation, it is intentional allocation, keeping fixed costs controlled while assets expand, allowing lifestyle to grow slower than ownership, building margin even when things feel good. Because the best time to build leverage is when you do not urgently need it. The best time to reduce pressure is before pressure appears. The best time to question comfort is while it still feels safe. Most people wait for discomfort to force change. Layoffs, market shifts, economic contractions. That is reactive adjustment. Reactive adjustment is expensive. Proactive compression is strategic. Reducing baseline voluntarily, redirecting surplus consistently, building ownership quietly, letting compounding do the work that effort cannot. Over time, the difference becomes visible, not in lifestyle first, in posture, in negotiation, in decision-making clarity. You stop protecting income at all costs. You start protecting leverage. Leverage removes ceilings, not instantly, gradually. But gradually is enough. The cost of being comfortable is paid in missed compounding, missed leverage, missed autonomy. But it is reversible if examined early. Comfort should support expansion, not replace it. If this reframed how you see stability, subscribe. Like this if it clarified something. Most people believe money is about intelligence, about strategy, about knowing what to buy, when to sell, where to invest. But most financial outcomes are not determined by knowledge. They are determined by emotion, fear, greed, status, security. These forces shape far more financial decisions than spreadsheets ever will. Emotion feels invisible in the moment. Your purchase feels justified. Your hesitation feels rational. Your risk feels necessary. But emotion distorts allocation. It redirects money away from strategy and toward relief. Relief from anxiety, relief from comparison, relief from uncertainty, relief from discomfort. A raise appears. Emotion says, upgrade your life. A market dips. Emotion says, protect what remains. A friend succeeds. Emotion says, catch up. None of these impulses are irrational. They are human. But markets do not reward human impulses. Markets reward discipline. The most expensive financial mistakes rarely come from ignorance. They come from reaction. Buying when excitement peaks, selling when fear spikes, expanding lifestyle when income increases, reducing investment when volatility rises. Emotion converts long-term strategy into short-term response. Short-term response interrupts compounding. Interrupted compounding quietly reshapes your future. Compounding demands patience. Emotion demands action. Patience feels uncomfortable. Action feels productive. So most people act. They adjust portfolios. They upgrade lifestyles. They respond to headlines. Every reaction feels justified, but each reaction introduces friction into compounding. The irony is clear. The more emotionally involved someone becomes with money, the worse their outcomes tend to be, because emotional involvement amplifies volatility, not market volatility, personal volatility. Personal volatility changes allocation. Allocation determines trajectory. Trajectory determines wealth. Money without emotion behaves differently. It ignores comparison. It ignores short-term narratives. It ignores temporary fluctuations. Emotionless money follows structure. Income arrives, surplus is redirected, assets accumulate, time compounds. Nothing dramatic, nothing reactive, just repetition. But repetition over decades produces separation. Most people never reach that state because money is tied to identity. Income reflects status. Spending reflects success. Loss feels like failure. When identity attaches to money, emotion becomes unavoidable, and emotional finance becomes expensive, not instantly, but structurally. Emotion increases spending during highs. Emotion decreases investing during lows. Emotion shortens time horizons. Short horizons destroy compounding. Money without emotion is not cold. It is strategic. It separates identity from allocation. It treats capital as a tool, not a signal of worth. That separation is rare, because most financial decisions are not financial. They are psychological. And psychology, when left unmanaged, can quietly sabotage the very wealth people believe they are pursuing. Emotion changes the timeline of money. Strategic capital moves slowly. It accumulates. It waits. It compounds. But emotional capital moves quickly. It reacts. It adjusts. It searches for relief. Relief is expensive. When markets rise quickly, emotion introduces urgency. You feel late. You feel behind. You feel pressure to participate. Pressure compresses judgment. Instead of evaluating structure, you evaluate momentum. Instead of asking what something is worth, you ask how quickly it is rising. Emotion converts patience into impatience. Impatience converts strategy into reaction. Reaction rarely aligns with timing. The same pattern appears during decline. Prices fall. News becomes darker. Uncertainty expands. Emotion demands protection. Protection feels rational. You reduce exposure. You move capital to safety. You pause allocation. All understandable reactions, but markets reward endurance, not comfort. When fear removes capital from the system, compounding is interrupted, and interrupted compounding reshapes long-term outcomes. The pattern repeats across decades. People buy enthusiasm, people sell anxiety. And between those two emotional states, wealth quietly transfers. Not through intelligence, through emotional control. Those who detach emotionally from price movement treat volatility differently. Volatility becomes opportunity. Price movement becomes data. Noise becomes irrelevant. This does not eliminate uncertainty, it reframes it. Uncertainty becomes a condition to navigate, not a signal to panic. Money without emotion behaves structurally. Allocation remains consistent. Strategy remains intact. Time horizon remains long. Those three conditions allow compounding to operate. Emotion disrupts all three. Allocation becomes reactive. Strategy becomes flexible in the wrong ways. Time horizon shrinks. Shrinking time horizons destroy exponential outcomes because exponential growth requires patience. Patience requires emotional stability. This is why emotional investors often feel busy. They constantly adjust, rebalance, respond, monitor. But activity is not progress. Progress in capital allocation often appears boring. Slow reinvestment, slow accumulation, slow expansion of ownership. Nothing dramatic, nothing urgent. Emotion struggles with boredom. Boredom invites interference. Interference invites mistakes. Mistakes compound. Over long periods, emotional interference creates drag. Small adjustments, small withdrawals, small reallocations. Individually insignificant, collectively expensive. Because compounding rewards stillness. Emotion rewards movement. The two rarely coexist. Those who separate money from emotion do not eliminate feeling. They simply prevent feeling from controlling allocation. That distinction changes everything. Money becomes mechanical. Surplus flows into assets. Assets expand over time. Volatility becomes irrelevant. Emotion fades. Structure remains. And structure, when paired with time, is what quietly produces wealth long after emotional decisions have faded. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Emotion does not only affect investing, it shapes spending. Most purchases are not financial decisions, they are emotional responses. Relief from stress, reward for effort, validation of progress. A difficult week ends, spending feels justified. A promotion arrives, upgrading lifestyle feels natural. A friend succeeds, matching their progress feels necessary. None of these moments feel irrational, they feel earned. But emotional spending changes financial trajectory. When income increases, emotion encourages expansion, bigger housing, better transportation, more visible upgrades. Each upgrade becomes normal quickly. Normalization is powerful. What once felt luxurious becomes baseline. Baseline becomes expectation. Expectation becomes obligation. Obligations reshape financial flexibility. Higher baseline means higher required income. Higher required income increases pressure. Pressure reduces optionality. Optionality is the foundation of leverage. Emotion rarely considers leverage. Emotion focuses on immediate satisfaction. Ownership requires delay. Delay feels uncomfortable, so consumption arrives first. The order matters. Consume first, invest later. Or invest first, consume later. Those two sequences produce radically different outcomes. Most people invert the order. Income increases, lifestyle expands, investing receives whatever remains. What remains is often inconsistent, and inconsistency weakens compounding. Compounding requires repetition. Emotion interrupts repetition. A good year encourages celebration. A difficult year encourages caution. Both emotions disrupt disciplined allocation. Celebration increases spending. Caution reduces investing. Over decades, this emotional rhythm erodes wealth quietly, not through large mistakes, through small inconsistencies. Small inconsistencies compound into large differences. Money without emotion follows a different sequence. Income arrives, surplus is captured, assets are acquired, lifestyle expands slowly. This sequence preserves leverage. Assets grow before obligations. Ownership expands before baseline. Optionality increases over time. Optionality changes behavior. When your financial structure is light, you tolerate uncertainty. You negotiate more confidently. You make long-term decisions more calmly. Emotionless money creates distance. Distance between identity and spending. Distance between headlines and allocation. Distance between volatility and panic. That distance is strategic because emotional proximity to money creates distortion. You check balances constantly. You react to fluctuations. You measure progress through comparison. Comparison intensifies emotion. Emotion accelerates decisions. Accelerated decisions weaken structure. Weak structure cannot support compounding, and without compounding, financial progress remains linear. Linear progress feels productive, but exponential progress requires discipline beyond emotion. It requires systems that operate whether you feel confident or uncertain. Money without emotion is not detached from reality. It simply refuses to let feelings dictate allocation. That refusal protects the one thing emotion often destroys: time. Because time, uninterrupted, is the engine of wealth. Emotion does something else to money. It shortens perspective. When decisions are emotional, the future becomes secondary. You optimize for how something feels now, not how it compounds later. A purchase relieves stress. A sale removes anxiety. A reaction provides temporary control. But temporary control often sacrifices long-term leverage. Emotion prefers certainty, even if that certainty is expensive. Selling during volatility creates relief. Spending during success creates validation. Avoiding risk creates comfort. Comfort is expensive in a compounding system because compounding rewards endurance. Endurance requires emotional neutrality. Neutrality is rare. Money is tied to identity. Income signals status. Spending signals success. Loss signals failure. When money carries identity, every financial fluctuation feels personal. Market declines feel threatening. Investment losses feel humiliating. Someone else's success feels comparative. Those emotions create pressure. Pressure accelerates decisions. Accelerated decisions reduce discipline. Reduced discipline interrupts compounding. This is why many intelligent people struggle with money, not because they lack information, because they cannot detach from it. Detachment does not mean indifference. It means separation. Money becomes a tool, not a reflection of worth. When money becomes a tool, allocation becomes mechanical. Income arrives, surplus is redirected, assets accumulate, time compounds. Nothing dramatic happens year to year. No emotional highs, no emotional crashes, just repetition. But repetition creates momentum. Momentum expands asset base. Asset base reduces dependency. Reduced dependency creates autonomy. Autonomy is the quiet goal behind most financial ambition. But emotional finance delays it, because emotion prioritizes feeling over structure. Structure requires consistency. Consistency requires systems. Systems operate regardless of mood, regardless of market noise, regardless of comparison. Emotion disrupts systems. It introduces exceptions. Exceptions weaken discipline. Weak discipline weakens compounding. And compounding is fragile, not mathematically, psychologically. It requires patience longer than emotion prefers. Money without emotion preserves patience. It protects allocation. It allows time to do what emotion interrupts. Over decades, that difference becomes enormous, not because of brilliance, because of restraint, because of distance, because of discipline. Emotion makes money reactive. Structure makes money strategic. And strategy, over long horizons, quietly wins. The objective is not to remove emotion from your life. It is to remove emotion from your allocation. You will always feel things about money: pride when income rises, anxiety when markets fall, comparison when others appear ahead. These reactions are human. The mistake is letting those reactions direct capital, because capital compounds based on structure, not feeling. If your allocation changes every time emotion shifts, your financial strategy never stabilizes, and without stability, compounding struggles to operate. Compounding needs consistency, consistent investing, consistent restraint, consistent time horizons. Emotion disrupts all three. A good year triggers celebration. A difficult year triggers caution. Celebration increases spending. Caution reduces investing. Both interrupt momentum. Momentum matters more than intensity. Small, disciplined allocations repeated over decades outperform large, emotional decisions made sporadically. Money without emotion behaves differently. Income arrives. A portion is captured. Assets are acquired. The process repeats. No celebration adjustments, no panic adjustments. Just structure. Structure does something emotion cannot. It removes decision fatigue. You do not constantly evaluate what to do. The system does it for you. Income to surplus to assets to time. When the system is in place, emotion becomes background noise. Markets fluctuate, headlines change, comparisons appear, but allocation remains intact. That distance protects compounding. Compounding transforms ordinary discipline into extraordinary outcomes, not quickly, but inevitably. Over decades, emotional finance produces volatility. Strategic finance produces expansion. The difference is rarely knowledge. It is emotional control. Most people lose money during excitement and protect money during fear. Both are expensive, because wealth is built in the opposite sequence. Invest during uncertainty. Restrain during success. That inversion feels unnatural, but it is structural, and structure always outperforms impulse. Money without emotion does not remove risk. It removes distortion. It allows you to see allocation clearly, to think in decades instead of weeks, to build systems instead of reactions. When emotion no longer drives your capital, time begins working with you. And when time compounds uninterrupted, wealth becomes a byproduct of discipline. If this changed how you see money, subscribe. Like this if it clarified something. Security feels intelligent. A stable paycheck, a predictable schedule, a reliable routine. It feels responsible. You reduce volatility. You minimize uncertainty. You avoid unnecessary risk. That seems rational. But security is never free. It is exchanged for something. Every stable structure removes instability, but instability is where leverage forms. When you eliminate volatility completely, you often eliminate upside with it. Security is a trade. You trade uncertainty for predictability. You trade optionality for stability. You trade expansion for containment. Containment does not feel restrictive at first. It feels calm. Bills are covered. Income arrives consistently. Future looks linear. Linear futures are comfortable, but they are also capped. When your income is fixed within a narrow band, your growth becomes incremental. Incremental growth rarely compounds into autonomy. The trade is subtle. You accept stable employment. In exchange, you accept income limits. You accept predictable advancement. In exchange, you accept structural dependence. Dependence is rarely acknowledged because it is normalized. You depend on employer stability, on market demand, on continued performance. As long as those variables hold, security feels intact. But if security depends on variables outside your control, it is conditional. Conditional security is not freedom. True independence requires assets that operate without constant permission. Security often delays asset accumulation because asset accumulation requires exposure. Exposure feels uncomfortable. The system prefers you stable. Stable workers, stable consumers, stable participants. Stability makes you predictable. Predictability makes you manageable. Manageable positioning rarely produces leverage. Leverage requires stepping beyond guaranteed outcomes, but guaranteed outcomes feel safer, so most people remain inside them. Here is the quiet cost. When you optimize for security, you reduce the range of possible outcomes. Reduced range means reduced upside. Reduced upside means slower separation. Over time, those who accepted calculated instability build structures that compound. Those who avoided it maintain position. Maintenance feels wise, but maintenance is not expansion. Security narrows focus to preservation. Preservation protects income. It does not multiply it. Multiplication requires exposure to risk. Risk does not mean recklessness. It means allocation into ownership. Ownership fluctuates. Ownership demands patience. Ownership demands tolerance. Security reduces tolerance because the more comfortable you become, the more uncomfortable volatility feels. The less volatility you tolerate, the less ownership you pursue. The less ownership you pursue, the more dependent you remain on income. And income, no matter how strong, is capped by time. Security is a trade. You give up acceleration for reassurance. You give up leverage for predictability. The question is not whether security is wrong. The question is whether you understand what you are exchanging for it, because every stable position comes with a ceiling, and ceilings rarely announce themselves until you attempt to rise beyond them. The trade becomes clearer over time. Security protects you from sharp drops, but it also limits sharp rises. When you anchor your life to stability, you begin filtering decisions through preservation. Will this disrupt income? Will this increase uncertainty? Will this introduce volatility? Volatility feels threatening when your structure depends entirely on smoothness. If one disruption creates stress, you avoid disruption. Avoiding disruption limits experimentation. Limited experimentation limits leverage. Leverage rarely forms inside guaranteed paths. It forms in allocation, in ownership, in strategic exposure. Security narrows the bandwidth of acceptable outcomes. You reduce downside, but you also compress upside, and compressed upside compounds into limitation. Most people believe security and growth are aligned. They are often in tension. The safer your income source, the less urgency you feel to build alternatives. The less urgency you feel, the longer you delay ownership. Delay is expensive in a compounding system. Time amplifies what you place into it. If you place only income into time, income rises slowly. If you place ownership into time, ownership multiplies. Security encourages income optimization. It rarely encourages structural redesign. You negotiate raises, you increase performance, you stabilize your position, all rational moves. But rational inside one framework can be limiting in another. If your primary objective is preservation, your allocation strategy becomes conservative. Conservative allocation reduces volatility. Reduced volatility reduces exponential upside. And exponential upside is what changes trajectory. Not incremental increases, not cost of living adjustments, not marginal promotions. The longer you remain inside high security structures, the harder it feels to step outside them, because baseline expands, lifestyle adjusts upward, obligations accumulate, risk tolerance shrinks. Shrinking risk tolerance narrows options. Narrow options reduce strategic flexibility. Reduced flexibility reinforces dependence. Dependence reinforces the need for security. The loop tightens. Security becomes self-reinforcing. You stay because leaving feels risky. Leaving feels risky because you stayed. Meanwhile, those who accept calculated instability early build buffers. They redirect surplus into assets. They build secondary income streams. They diversify control. Control is the opposite of dependence. Security can mask dependence. Control reduces it. The paradox is clear. The more secure you feel, the less control you may actually have. Because control comes from leverage. Leverage comes from ownership. Ownership requires exposure. Security trades exposure for reassurance. Reassurance feels calm. Exposure feels uncomfortable. But discomfort often carries upside. Over decades, this trade compounds. One path produces stable income with limited autonomy. The other produces fluctuating growth with expanding leverage. Neither is accidental. Both are structured. The difference is what you were willing to exchange for the feeling of safety. If this feels familiar, if you've felt this pressure but never had words for it, this channel isn't here to motivate you. It's here to help you see clearly. If that resonates, like the video. Subscribe. More clarity is coming. The longer you choose security, the more expensive flexibility becomes. Early in your career, instability is tolerable, expenses are lower, identity is still forming, obligations are limited. You can experiment, you can compress, you can reallocate. But security compounds into structure. Structure hardens over time. Higher baseline, more commitments, more predictable expectations. Each layer feels justified. None feel restrictive. Until you attempt to change direction. At that point, the cost of instability feels amplified. Not because opportunity is worse, because your structure is heavier. Heavier structures resist movement. This is where the compounding trade becomes visible. Security reduces volatility early. Reduced volatility delays ownership. Delayed ownership reduces compounding. Reduced compounding increases long-term dependency. Dependency increases sensitivity to disruption. The more sensitive you become, the more you value security. The more you value security, the less you allocate toward leverage. The loop tightens. Meanwhile, compounding continues for those who accepted earlier discomfort. They endured uneven income. They tolerated uncertainty. They reinvested aggressively. Their structure becomes lighter over time, not heavier. Light structures move. Heavy structures protect. Protection preserves position. Movement changes it. The irony is subtle. Security feels like strength, but often it is rigidity. Rigidity limits adaptation. Adaptation creates advantage. Advantage compounds when paired with ownership. Ownership compounds when paired with time. Time amplifies allocation. If allocation is conservative for too long, separation widens. Separation does not feel dramatic year by year. It reveals itself decade by decade. The person who optimized for security may still earn well, but their ceiling remains intact. The person who optimized for leverage may have experienced volatility early, but their ceiling rises. Rising ceilings change behavior. You negotiate differently when income is diversified. You take calculated risks when baseline is controlled. You wait strategically when you are not pressured. Pressure is the hidden cost of security, because when all income depends on one source, that source controls negotiation. Control limits autonomy. Autonomy requires alternatives. Alternatives require earlier instability. Earlier instability requires tolerance. Tolerance requires vision beyond immediate comfort. Security trades that vision for reassurance. Reassurance is temporary. Compounding is permanent. Over time, the trade becomes structural. Stable income, stable lifestyle, stable ceiling. You are protected, but you are contained. And containment compounds quietly when unexamined. Security is not the problem. Unexamined security is. There is nothing irrational about wanting stability. You want bills covered. You want predictability. You want protection against collapse. That is intelligent. The mistake is assuming security and autonomy are the same. They are not. Security protects income. Autonomy reduces dependence on it. If your entire structure depends on one predictable stream, you are secure, conditionally. Conditional security is fragile, because the condition is not fully yours. Real control begins when security is layered. Income from effort, income from ownership, margin in reserve, flexibility in structure. Security without ownership creates containment. Ownership without discipline creates volatility. The objective is not recklessness. It is balanced exposure. Exposure to assets, exposure to leverage, exposure to opportunities that may fluctuate but expand ceiling. You do not need to abandon stability. You need to reduce reliance on it. Gradually, strategically, redirect surplus into ownership. Limit fixed commitments. Build alternatives before you need them. Alternatives create negotiation power. Negotiation power reduces pressure. Reduced pressure expands decision range. Decision range is autonomy. Most people wait until security cracks to begin building leverage. By then, pressure is high. Options are fewer. Risk tolerance is low. That is reactive restructuring. Proactive restructuring is quieter. It happens when things are still stable, when income is consistent, when life feels predictable. That is when you compress lifestyle growth. That is when you redirect surplus. That is when you build secondary structures. Security becomes a foundation, not a cage, a base layer, not the entire strategy. Because security is always a trade. The question is how much upside you are willing to exchange for reassurance. If you understand the trade, you can design around it. You can maintain stability while building leverage. You can protect downside without eliminating upside. That balance changes trajectory. If this shifted how you see stability and risk, subscribe. Like this if it clarified something. Stability feels like the goal. A steady paycheck, predictable routines, a life where nothing collapses unexpectedly. From the outside, stability looks like success. You're reliable, responsible, disciplined. Bills are covered. Stress is manageable. The future looks predictable. Predictability feels like control. But stability is not control. It is containment. When your life becomes stable, something subtle happens. Urgency fades. You stop asking structural questions. You stop asking, how do I build leverage? How do I build ownership? How do I reduce dependency? Instead, the focus shifts. How do I maintain this? How do I protect this? How do I avoid disruption? Maintenance becomes the strategy, and maintenance feels intelligent because nothing is breaking, nothing is collapsing, everything works. But systems that only maintain eventually plateau. Plateaus feel calm. They also quietly limit expansion. The first cost of stability is urgency. When survival pressure disappears, ambition often softens. You stop redesigning your financial structure. You refine the one you already have. Refinement improves income. Redesign builds wealth. Income supports your lifestyle. Ownership reshapes your trajectory. Those two forces operate on different timelines. A stable job increases income gradually. An asset base compounds. Compounding accelerates. Income does not. When stability dominates your strategy, income becomes the primary engine of progress. But income has limits. Time limits it. Energy limits it. Opportunity limits it. Assets operate differently. Assets detach growth from effort. They expand even when you are not actively working. They accumulate quietly. But building assets requires discomfort, uncertainty, delayed gratification. Stability removes the emotional pressure that pushes people toward those choices. When life works well enough, the incentive to build leverage weakens. Comfort encourages preservation. Preservation discourages risk. Risk avoidance limits ownership. This shift happens slowly, not through one dramatic decision, through 1,000 small ones. Choosing upgrades over investments, choosing routine over redesign, choosing predictability over opportunity. Each decision feels harmless. Each one protects stability. But together they create a ceiling. Ceilings rarely appear suddenly. They form quietly, invisible at first. You still earn, you still progress, but progress becomes linear. Linear progress feels productive, but wealth is rarely linear. Wealth is exponential. Exponential growth requires patience. Patience requires discipline. Discipline often requires discomfort. Stability removes discomfort, and without discomfort, most people stop expanding their structure. They protect the life they built, instead of building the life that compounds. That is the first price of stability, not failure, not collapse, containment. A life that functions well but expands slowly. And slow expansion over decades creates the quiet difference between stability and freedom. The second price of stability is tolerance. Not tolerance for difficulty, tolerance for risk. When your life becomes predictable, your relationship with uncertainty changes. Volatility stops feeling like opportunity. It starts feeling like threat. If your income arrives consistently, anything that threatens that consistency feels dangerous. Even when the opportunity is rational, even when the upside is significant. Security trains the mind to protect. Protection becomes instinct, and instinct shapes allocation. You begin choosing certainty over leverage, predictable income over ownership, stable growth over exponential growth. Each decision makes sense in isolation, but over time the pattern compounds. You reduce exposure to volatility. Reduced volatility reduces risk. Reduced risk reduces upside. Upside is where separation occurs, not in marginal raises, not in incremental promotions, in ownership. Ownership fluctuates. Ownership feels unstable. That instability is the price of acceleration. But stability conditions people to avoid acceleration, because acceleration requires tolerance for uncertainty. The longer someone lives inside predictable systems, the more uncomfortable unpredictability becomes. Risk tolerance shrinks. Opportunity begins to feel reckless. What once looked like possibility starts to look like threat. This is how stability quietly reshapes behavior. It narrows the range of acceptable outcomes. You choose safe expansions, small investments, low volatility allocations. Everything feels responsible. Responsibility is important, but responsibility without leverage creates ceilings. Leverage requires asymmetry. Limited downside, massive upside. Those opportunities rarely feel stable. They appear uncertain, uncomfortable, unpredictable. And stability trains people to reject all three. Meanwhile, those willing to tolerate controlled instability begin accumulating ownership. Ownership compounds. Ownership multiplies. Ownership eventually detaches income from effort. That detachment changes everything. Income becomes optional. Negotiation power increases. Time becomes flexible. Flexibility is what people think stability provides. But stability rarely provides flexibility. It provides reliability. Reliability means you know what will happen. Flexibility means you can choose what happens. Those are very different conditions. Flexibility requires margin. Margin requires assets. Assets require earlier instability. Most people invert the sequence. They seek stability first. They delay ownership. They delay leverage. They delay risk. By the time they want flexibility, their structure is too heavy to move easily. Obligations are higher. Baseline is higher. Risk tolerance is lower. So stability becomes permanent, not because it was the goal, because it quietly removed the tolerance required to escape it. That is the second price of stability. Not stagnation, restriction. A narrowing range of choices that compounds quietly over time. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. The third price of stability is time. Not the time you spend working, the time you lose to slow structures. Stable systems move predictably. Predictable systems move slowly. Salary increases come gradually. Promotions arrive occasionally. Progress happens in measured increments. That rhythm feels normal. But wealth does not grow at a normal pace. It grows exponentially. Exponential systems reward early positioning. The earlier capital enters the system, the longer compounding operates. The longer compounding operates, the faster growth accelerates. Time amplifies structure. If your structure is linear, time multiplies linear results. If your structure is exponential, time multiplies acceleration. Stability tends to anchor people to linear structures. Work more, earn slightly more, upgrade slightly more, repeat. Each cycle feels productive, but productivity is not the same as leverage. Leverage changes the slope of progress. Without leverage, progress depends entirely on effort. Effort has limits. Hours are finite. Energy is finite. Opportunity is finite. Assets operate differently. Assets multiply through time. Multiplication creates separation. Separation rarely appears early. It appears later, when compounding reaches escape velocity. By then, the difference is dramatic. Two people start with similar incomes. One prioritizes stability. The other prioritizes ownership. At first, their lives look identical. Similar salaries, similar lifestyles, similar progress. But ownership compounds silently. Each year returns reinvest. Each reinvestment accelerates the next. Growth becomes non-linear. Meanwhile, the stable path continues predictably. Income increases, expenses increase, savings increase slowly. Everything appears responsible. But responsible structures are not always accelerating ones, and acceleration is what changes financial reality. The longer someone stays inside purely stable systems, the more compounding time they surrender. Lost compounding time is expensive. Not immediately, over decades. 10 years of delayed ownership can mean 20 years of delayed autonomy, because compounding needs runway. Runway disappears when time is consumed by maintenance. This is why stability feels safe early. Nothing dramatic happens, nothing collapses, nothing appears wrong. But the absence of crisis does not mean the presence of acceleration. Acceleration requires allocation. Allocation requires discipline. Discipline requires prioritizing assets before lifestyle expansion. Most stable systems invert that order. Income increases, lifestyle expands, investing receives the remainder. The remainder rarely compounds aggressively. Over decades, the difference grows, not through dramatic decisions, through structure. Structure determines trajectory. Trajectory determines wealth. And stability, when left unexamined, often anchors people to structures that move too slowly for compounding to fully take over. Stability is not the enemy. Misunderstanding it is. Stability should be a foundation, not a destination. A stable income can support discipline. A stable life can create margin. A stable routine can allow long-term thinking. Those are advantages. The mistake is turning stability into the entire strategy. When stability becomes the goal, expansion quietly disappears. Maintenance replaces momentum. Protection replaces allocation. Predictability replaces leverage. Over time, that shift becomes structural. Income supports lifestyle. Lifestyle supports obligations. Obligations require continued stability. The loop closes. At that point, stability is no longer optional. It becomes necessary, and anything that threatens it feels unacceptable. But real financial strength comes from optionality, the ability to walk away, the ability to wait, the ability to choose. Optionality requires assets. Assets require earlier discipline. Discipline requires resisting automatic lifestyle expansion. That resistance feels strange in stable environments. When income rises, the natural instinct is improvement. A better house, a better car, a better standard of living. But standards rise faster than people expect, and rising standards quietly raise financial gravity. Higher gravity makes movement harder. This is why many people with strong incomes still feel constrained. Their income supports stability, but their structure does not support flexibility. Flexibility comes from leverage. Leverage comes from ownership. Ownership comes from consistent allocation.
allocation before celebration, assets before upgrades, structure before comfort. When stability is used correctly, it becomes powerful. It creates the conditions needed for disciplined investing. Predictable income funds consistent ownership. Ownership compounds quietly. Over time, the structure changes. Income becomes less essential. Assets begin carrying more weight. Pressure declines. Choices expand. Stability then serves its real purpose, not as the ceiling of your life, but as the platform that allowed compounding to begin. The price of stability is only paid when stability replaces strategy. Used correctly, it becomes leverage. Used incorrectly, it becomes containment. If this reframed how you see stability, subscribe. Like this if it clarified something.
Most people believe they understand money. They went to school. They learned math. They learned discipline. They learned how to work. But almost no one was taught how money actually works. You were taught how to become employable, how to build a resume, how to qualify for a salary. You were trained to earn, not to accumulate. That distinction shapes almost every financial outcome because earning money and building wealth operate under completely different rules. Income is linear. You trade time for money. More hours, more effort, more responsibility, more pay. It feels like progress, and in many ways it is. But income resets. Every month, every paycheck. You work, you earn, you spend, you repeat. The cycle restarts again. Even high incomes operate inside this loop. A larger salary improves lifestyle. It rarely changes the structure of the cycle. Because income depends on continued effort. If effort stops, income stops. Wealth works differently. Wealth does not reset. Wealth compounds. Assets accumulate. Returns build on previous returns. Ownership expands. Compounding changes the slope of progress. Income grows step by step. Assets grow through acceleration. But the system most people move through does not prioritize accumulation. It prioritizes participation. Education prepares people to enter the workforce, not to exit dependence on it. Careers are designed to increase income, not necessarily to build ownership. Ownership changes leverage. When you own assets, income becomes optional. When you rely only on income, work remains mandatory. That difference is rarely explained early, because the system needs workers. Workers sustain institutions. Workers sustain production. Workers sustain consumption. Participation keeps the machine moving. Ownership changes who benefits from it. So the system teaches stability, reliable income, predictable progress, structured careers. Those are not mistakes. They create order. They create productivity. They create functioning economies. But they do not automatically create wealth. Wealth requires a shift most people are never shown, moving from earning to owning, from participation to leverage, from income cycles to asset accumulation. That shift does not feel dramatic at first. It often begins quietly. Saving a portion of income, redirecting surplus into assets, owning small pieces of productive systems. Over time, those pieces compound. The difference grows slowly at first, then it accelerates. Meanwhile, someone operating purely inside the income cycle may continue progressing steadily. Promotions, raises, better lifestyle. But the structure remains the same. Income supports life. Effort sustains income. Time limits effort. And time is the one constraint income cannot escape. Assets can. Assets expand while you sleep, while you work, while you wait. That is why the first lesson about money is rarely the one people were taught. The goal is not just to earn. It is to redirect earning into systems that compound, until eventually, money begins working even when you are not. The moment you understand ownership, the system begins to look different. Not hostile, not conspiratorial, structured. Because every functioning economy runs on two roles: labor, ownership. Labor produces value, ownership captures a portion of that value. Both are necessary. Factories need workers, companies need employees, services require effort. None of that is wrong. But the difference between producing value and capturing value creates the financial gap most people eventually notice. Workers exchange time for income. Owners exchange capital for leverage. Those two exchanges operate under different rules. Labor scales slowly. You can work longer hours, gain more experience, earn promotions, but effort always remains tied to time. Ownership scales differently. A business grows, a property appreciates, a portfolio compounds. One decision can influence thousands of outcomes. That is leverage. Leverage allows one unit of effort to produce disproportionate results. And leverage is what creates wealth, not effort alone. This is the second lesson about money most people were never taught. Effort is necessary, but effort without ownership has limits. The system does not hide this. It simply does not emphasize it. Because early in life, the priority is employability, skills, reliability, income stability. Ownership usually arrives later, often after years inside the workforce, after income becomes predictable, after savings begin accumulating. By that point, the gap between labor and ownership is already visible. You see companies expanding, investors accumulating, assets increasing in value. Meanwhile, salaries rise slowly. Responsibility increases, but the structure remains familiar. Work to income to lifestyle to repeat. The realization begins quietly. Working produces money. Owning produces leverage. And leverage changes outcomes over long periods of time. A worker may increase income steadily. An owner may experience uneven progress. But when ownership compounds, the acceleration becomes obvious. This is why the wealth gap widens, not because workers are failing, but because ownership compounds faster than effort. Compounding rewards time and scale. Effort is limited by both. Ownership expands beyond them. This is not about abandoning work. Work often funds ownership. Income creates the capital that eventually becomes leverage. But without that transition, effort remains trapped inside a linear structure. You improve within the system. You rarely move beyond it. Ownership changes the relationship entirely. You stop selling time. You begin accumulating influence inside systems that produce value. Businesses, equity, real estate, markets. Small pieces at first, then larger ones. Then compounding begins doing the work effort cannot. This is the shift most people eventually discover. The system did not only reward effort, it rewarded ownership. And once that difference becomes clear, money begins to behave very differently. If this made sense to you, you already understand more than most people do. This channel exists for that kind of awareness. Like the video, subscribe. Nothing here is accidental. Even after people understand ownership, many still believe effort can close the gap. Work harder, work longer, climb higher. Effort feels like the most direct path forward. It is visible, it is measurable, it produces immediate income. So the assumption becomes simple. If effort created progress before, more effort should create more progress. But effort operates inside a linear system. Linear systems move step by step. 1 hour of work produces 1 unit of value. 2 hours produce 2. Ownership operates inside a different system, exponential systems. Exponential systems behave quietly at first. Growth appears slow. Returns seem small. Nothing dramatic happens early. But exponential systems accelerate. Each return builds on the last. Each cycle expands the base. Over time, the curve bends upward. That is compounding. And compounding changes the scale of outcomes. Effort increases income. Compounding multiplies capital. Those are fundamentally different mechanics. One grows through labor, the other grows through time. Time amplifies ownership, but time does very little for income alone. You can earn more with experience, but experience cannot multiply hours. Eventually, every career encounters the same limit. Time remains fixed. Energy declines. Opportunities plateau. Ownership does not encounter those same constraints. Assets do not sleep. Assets do not burn out. Assets do not require hourly effort. They expand as systems expand. Markets grow. Businesses scale. Economies compound. When you own a portion of those systems, your capital grows alongside them. This is why effort alone rarely closes the wealth gap. Not because effort lacks value, because effort cannot accelerate. Acceleration requires leverage. Leverage requires ownership. Ownership requires earlier allocation. Without that sequence, progress remains steady but contained. Income rises gradually. Lifestyle improves gradually, but the structure never changes. Work funds life. Work sustains income. Work remains essential. Meanwhile, those who allocate capital into ownership begin experiencing a different curve. At first, nothing appears different, but over time, the acceleration becomes visible. Assets produce returns. Returns reinvest. Reinvestment compounds. Eventually, capital begins doing something effort cannot. It grows independently. That independence is the turning point, the moment when work stops being the only engine of progress. This is the lesson rarely explained early. Effort builds the starting point. Ownership builds the trajectory. Without ownership, effort keeps life moving. With ownership, money begins moving on its own. And once that shift begins, the financial system starts working with you instead of only requiring you. Once you see the difference between earning and owning, the system stops looking confusing. It starts looking mechanical. Income enters your life. That income can move in two directions: consumption or accumulation. Consumption improves the present: better housing, better transportation, better experiences. There is nothing inherently wrong with that. But consumption resets every month, every cycle. The money is used, and the process begins again. Accumulation behaves differently. Income is redirected. Assets are acquired. Ownership expands. Those assets begin producing returns. Those returns reinvest. Reinvestment compounds. Compounding accelerates. At first, the difference is invisible. Two people earn similar incomes. Two people live similar lifestyles. Progress appears identical. But the structures are different. One life runs on income. The other slowly builds ownership. Years pass. Income increases. Responsibilities increase. Lifestyle expands. Everything appears stable. But ownership compounds quietly in the background. Assets grow. Returns build on returns. Leverage expands.
Eventually, the separation appears, not through one dramatic moment, through accumulated years. The person dependent on income continues trading time. The person accumulating ownership begins gaining flexibility. Flexibility changes everything. You can wait, you can negotiate, you can decline opportunities that do not serve you. That is leverage, not control over markets, not perfect predictions. Control over your own dependence. When assets grow large enough, income stops being the only engine of progress. Money begins working independently. Effort becomes optional in ways it never was before. That transition rarely happens suddenly. It builds slowly, through discipline, through allocation, through patience. And that is what most people were never taught. The goal of earning money is not simply to sustain life. The goal is to redirect earning into systems that compound. From labor to ownership, from income to leverage, from effort to assets. Once that shift begins, the system starts behaving very differently. You are no longer only participating in it, you are accumulating influence inside it. And over long periods of time, that difference determines who simply earns money and who eventually builds wealth. If this changed how you see money, subscribe. Like this if it clarified something.
One of the most important things about money is also the least discussed: time. Not time spent working, time inside the system. Most people believe money rewards intelligence, or discipline, or effort. Those things matter. But the force that shapes outcomes more than anything else is duration. How long capital remains inside compounding systems. Because compounding does not behave the way most people expect. Early progress looks insignificant. Returns appear small. The system feels slow. But compounding is not designed to impress you early. It is designed to accelerate later. At the beginning, growth is quiet. A small investment grows slightly. Returns appear modest. Progress seems almost invisible. This phase discourages most people. It feels inefficient, slow, unimpressive compared to income. Income produces immediate results. You work this month, you earn this month. You see the result instantly. Compounding asks for something different: patience. Capital is placed into assets. Time begins working quietly. Years pass with little visible difference. Then, something changes. Returns begin generating their own returns. Growth begins stacking on previous growth. The curve bends upward. Acceleration appears. But by that point, the people who benefit most are the ones who entered earliest, because compounding multiplies time. Time becomes leverage. This is the first rule about money that most people learn too late. Starting earlier matters more than being perfect. Perfect timing matters less than long duration. The difference between beginning at 25 and beginning at 40 can reshape the entire trajectory of wealth. Not because the later investor lacks intelligence, because the earlier investor had more time. Time compounds capital, but time also compounds mistakes. Delaying ownership, delaying investing, delaying allocation, all reduce the runway compounding requires. This is why many intelligent people feel financially behind later in life. They focused on earning first. They delayed investing. They postponed ownership. When they finally begin allocating capital, the system still works, but the acceleration phase arrives later. And later means less time for exponential growth. Time is the one advantage the system cannot recreate. Once it passes,
It cannot be replaced. This is rarely emphasized early. Instead, the focus is placed on income, degrees, careers, promotions. All of those increase earning potential. But earning potential does not automatically produce compounding. Compounding begins only when capital enters ownership systems, markets, businesses, assets. The earlier capital enters those systems, the longer compounding operates. The longer compounding operates, the less effort money requires later. That is the quiet power of time. Not dramatic, not exciting, but relentless. Because in the financial system, time does not reward the smartest participant. It rewards the one who started and stayed invested the longest.
If time is the engine of wealth, lifestyle is often the brake. Income rises, effort increases, careers progress, and with every increase, a quiet decision appears. Expand life. Or expand ownership. Most people choose expansion of life, not because they are irresponsible, because it feels natural. You worked harder, you earned more. Improving your lifestyle feels deserved. A better apartment, a better car, better restaurants, better vacations. None of these decisions feel dramatic. They feel like progress. But progress and expansion are not always the same, because lifestyle grows faster than people expect. The moment a new standard appears, it becomes normal. What once felt luxurious quickly becomes baseline. Baseline becomes expectation. Expectation becomes obligation. And obligations reshape financial gravity. When your baseline rises, your required income rises. Higher required income creates pressure. Pressure reduces flexibility. Flexibility is the hidden ingredient of wealth. It allows you to wait, to invest during uncertainty, to hold assets longer than emotion prefers. Lifestyle inflation quietly removes that flexibility because every upgrade introduces another commitment, another payment, another expense that must be sustained. Soon, income is no longer building wealth, it is maintaining structure. This is why many high earners still feel financially constrained. Their income improved, but their baseline improved with it. The gap between income and obligations remained the same, or sometimes even shrank. Meanwhile, compounding requires the opposite condition: surplus, capital that is not immediately consumed, capital that can enter ownership systems, stocks, businesses, real estate, assets that produce returns. Without surplus, compounding struggles, not because the strategy is wrong, because the fuel is missing. Lifestyle inflation quietly removes that fuel. Each upgrade redirects capital away from ownership, away from assets, away from compounding. At first, the difference seems small. One person invests a little more. Another upgrades lifestyle a little more. Both feel reasonable. But over time, the divergence becomes structural. The investor accumulates assets. The consumer accumulates obligations. Assets create flexibility. Obligations create dependency. Dependency makes income essential. Flexibility makes income optional. That distinction becomes clearer over decades. The person with controlled lifestyle has capital compounding quietly. The person with expanding obligations must maintain income to sustain their structure. Neither path looks dramatically different in the beginning. Both may appear successful. But one path preserves surplus. The other consumes it. And in the financial system, surplus is the seed of wealth. Without it, compounding never truly begins. Most content talks at you. This one sits with you. If that difference stood out, if this felt real instead of loud, Like the video, subscribe. This channel is built for people who notice patterns. The final rule people often discover too late is the role debt plays in the system. Debt is not inherently bad. Businesses use debt. Governments use debt. Investors use debt. It can accelerate growth when used strategically, but the kind of debt most people encounter is not designed to accelerate ownership. It is designed to accelerate consumption. Credit cards, car loans, consumer financing, buy now, pay later. Each one solves the same emotional problem: access today, payment tomorrow. That trade feels convenient. It allows lifestyle to expand faster than income, but it also introduces a new structure. Future income becomes obligated. Obligation changes the relationship with money. Income is no longer optional progress, it becomes required maintenance. Every payment anchors a portion of your future labor. Part of next month's income is already spoken for. Part of next year's effort is already committed. When obligations accumulate, the financial system begins behaving differently. Flexibility disappears. Risk tolerance shrinks. Opportunity becomes harder to pursue. Because income must remain stable. Stable income protects the structure. And the structure becomes heavy. Debt used for consumption often does something subtle. It pulls future effort into the present. You experience the lifestyle now, but you pay for it with tomorrow's labor. The system benefits from this structure. Consumption drives economic activity. Borrowing accelerates consumption. The cycle sustains growth. But for the individual, that cycle can create dependency. More obligations require more stable income. More stable income requires continued participation. Participation becomes mandatory, not strategic. This is why debt often anchors people to the income cycle, not because they lack discipline, because the structure demands consistency. The more obligations someone carries, the harder it becomes to redirect capital toward ownership. Payments come first. Assets come later. Later often becomes delayed. Delayed investing reduces compounding. Reduced compounding delays wealth formation. This is the final piece most people eventually notice. Time matters. Surplus matters, and obligations reshape both. Debt reduces surplus. Debt compresses time. Debt anchors future income to present decisions. That is why understanding the structure of money changes how decisions feel. A purchase is no longer just a purchase. It becomes a structural choice. Does this expand ownership, or does it increase obligation? One direction builds leverage. The other builds dependency. The system itself is not hidden. Its rules are simply learned slowly. Time compounds. Lifestyle consumes surplus. Debt anchors future income. Once those patterns become visible, money stops feeling mysterious. It starts looking structural. And structural systems can be navigated once you understand how they actually work. Once these rules become visible, money begins to feel less mysterious. Not easier, but clearer. Time compounds. Lifestyle consumes surplus. Debt anchors future income. These forces shape most financial outcomes, not intelligence, not luck, structure. People often search for complicated strategies, the perfect investment, the perfect timing, the perfect opportunity. But the financial system is not primarily defeated by cleverness, It is navigated through discipline. Time inside compounding systems. Surplus preserved instead of consumed. Obligations kept light enough to allow flexibility. Those three conditions change everything. Not immediately, but inevitably. Because compounding rewards consistency, not intensity. A small amount of capital invested consistently often outperforms large bursts of emotional decisions. The same is true for lifestyle. Controlled expectations preserve surplus. Preserved surplus fuels ownership. Ownership expands leverage, and leverage changes the relationship with income. Income becomes fuel for assets instead of the entire engine of progress. This is when financial pressure begins to decline, not because income stops mattering, because ownership begins carrying weight. Assets produce returns. Returns reinvest. Reinvestment compounds. The system begins working alongside you. Over time, the structure shifts. Income supports life. Assets support freedom. Freedom does not appear suddenly. It builds gradually, through time, through allocation, through restraint. That is what most people eventually realize. The rules of money were never mysterious. They were simply structural. Time, surplus, ownership. Once those pieces are in place, the financial system begins behaving very differently. Not as something you must constantly chase, but as something that quietly works in the background of your life. If this clarified how the system works, subscribe. Like this if it shifted your perspective.